Okay, let's unpack this. Today, we're pulling out the magnifying glass for something that might, at first glance, seem pretty straightforward, a corporate tax form. Specifically, Form 1120, the standard U.S. corporate income tax return. But here's the twist, and it's a significant one. We're not just looking at how a company reports its usual earnings. Oh, no. We're diving deep into how an utterly unconventional, multi-billion-dollar financial windfall, in our case, a massive arbitration award, doesn't just get reported, but how it fundamentally reshapes a company's entire financial strategy. It's really about how you account for the unexpected and then, maybe surprisingly, how you can turn that truly unique asset into a powerful strategic advantage, one that opens up entirely new avenues for growth and operations.
And our mission for you today, for everyone listening in, is really to decode precisely how such a substantial yet, atypical financial asset gets meticulously integrated into corporate tax reporting, and crucially, how it extends far beyond mere compliance. We're putting a particular spotlight on the absolutely indispensable role of Schedule L, which is essentially the company's balance sheet, right, as recorded for tax purposes. Understanding this intricate process, how an unusual asset like this finds its precise home on a financial statement, it can truly unlock much broader financial insights. And this understanding, it eventually leads to highly strategic ways to manage even everyday operational needs. For instance, how a company might approach payments to its extensive network of contractors. It's a fascinating journey, really, into the often overlooked power of strategic financial reporting and how it can be leveraged as a proactive business tool.
Okay, let's kick things off then. Let's set the scene for our fictional company. Imagine a service-based entity. Not a manufacturing giant, churning out widgets, or some sprawling retail chain with shelves full of products. No, this company operates without any physical inventory, so its value isn't tied up in goods on hand. Instead, its core business model relies really heavily on a dynamic network of specialized subcontractors to deliver its services. You could think of like a large IT consulting firm, maybe a major event management company, or perhaps a complex project management outfit that pulls in talent for specific engagements.
That's right. And the fact that our company is service-based, it actually brings a certain simplicity to the initial aspects of Form 1120, right from the start, which then, helpfully, allows us to focus on the truly unique elements. For instance, because it doesn't deal with physical goods, there's no need for them to complete Form 1125A. Now, that form, as many of you might know, is typically dedicated to calculating the cost of goods sold and, all the detailed inventory costing. Since our company provides services, not products, that entire section simply doesn't apply, which immediately streamlines a pretty significant portion of their tax preparation.
Right. So essentially, a service-based model simplifies the initial accounting. It just removes a whole layer of complexity.
Right.
But does that simplicity also mask any potential pitfalls? Or maybe unique challenges that, say, a manufacturing company wouldn't face?
That's a good question. While it removes inventory complexities, a service-based model often shifts the focus to managing human capital and contracts, which, can have its own nuances, though maybe less so on the initial Form 1120 setup itself. In our company's case, its total surface revenue gets reported directly as gross receipts. That's line 1A of the Form 1120. Straightforward enough, and importantly, all its payments to those subcontractors we mentioned, which are not traditional employee wages, right? They're fees for professional services rendered. Those are treated as ordinary and necessary business expenses. They're categorized under other deductions on the tax form, typically clearly labeled. Something like contract labor or subcontractor expenses to ensure transparency. What's fascinating here is how these seemingly straightforward structural choices actually streamline certain sections of Form 1120. They clear away some standard complexities. And this allows for a much sharper focus on the truly unique elements defining this company's financial picture. Specifically, its substantial pre-existing net operating losses, or NOLs, carried over from previous years. And then, of course, the monumental $1.2 billion arbitration award. These initial structural choices really do set the stage for how these profound financial events, the huge award and the existing NOLs, will deeply impact the company's balance sheet, which is Schedule L, as we mentioned, and its overall tax strategy, turning potentially standard reporting into, strategic leverage.
And speaking of monumental events, the defining feature, the monumental event for this company, is its $1.2 billion arbitration award. This isn't just a big number. It's a genuine game changer. Now, here's where it gets really interesting and, frankly, quite sophisticated. Our company has received this truly significant financial asset, a $1.2 billion arbitration award. This isn't revenue from selling a product or a normal service rendered in the usual course of business. No, So for anyone just looking at standard income streams, how does something this unique, this massive, this completely outside of the typical business cycle, how does it fit into the often, rigid world of corporate taxes? It sounds like it could be a real head scratcher.
Well, to truly understand how a multi-billion-dollar arbitration award is integrated into a company's finances and tax strategy, you really need to grasp the fundamental nature of arbitration itself. It's important to realize it's not some novel legal construct or, a modern invention. In fact, its lineage stretches back over 4,000 years, which really underscores its foundational and universally accepted nature. And this history is precisely why it carries such weight and financial power today as a binding instrument.
4,000 years, wow. That's quite a historical footprint for something so central to modern finance. We're talking ancient civilizations here then.
Absolutely. Ancient civilizations relied on it for dispute resolution all the time. It's even referenced in historical texts like the Book of Genesis, where disputes were settled by impartial figures. Or think about the famous judgment of King Solomon, that iconic story, right? Where a wise figure makes a final binding determination between disputing parties. An arbitrator is essentially an impartial private judge, agreed upon by the parties, whose decision is final and binding. This historical weight, it underlines why arbitration awards are not just recommendations, they are legally robust. They have teeth.
So it's an ancient method of settling disputes that still holds incredible weight today. That's quite a lineage for something that is so central to modern finance and corporate tax strategy.
Precisely. And the core principle behind its enforceability even today is that it creates a binding agreement. Because an arbitration award legally obligates parties to a specific performance, or more commonly, a payment. It inherently possesses value. It's not just a suggestion or a recommendation, it's a legal command, fully enforceable in courts of law.
I see. So the obligation itself, the legal command to perform or pay, that's what gives it this inherent value. That's a key distinction from, say, just a mere promise or a maybe.
And that leads to the crucial insight for our deep dive. An arbitration award, in itself, is a financial instrument. It's a written determination that assigns liability or benefit or specific performance, thereby creating a binding order. Because it involves an obligation associated with real quantifiable value, it absolutely meets the conditions of an instrument under common and commercial law, especially when it orders a payment or a specific performance. This isn't just a piece of paper. It represents a legally established claim with a determinable monetary value.
That's a profound point. The award is the instrument, not just a claim to one. So this isn't just a piece of paper saying someone might owe money down the road. It has inherent financial weight, almost like raw financial power, right from the moment it's rendered.
Absolutely. Think of it this way. An arbitration award can be monetized. It can be used as collateral for a loan. It can be enforced as a money judgment in a court, or it can even be registered as a financial asset. But here's the kicker, the truly fundamental point. An arbitration award is inherently a financial asset. It doesn't require external registration, like some securities might, to establish its value or legal standing. It holds that value, that inherent financial weight, from the very moment it's rendered. Based on those underlying agreements and obligations that led to the arbitration in the first place, it's fundamental from day one because the legal right to that money is established, period.
Okay. So if this award is a financial instrument and it's inherently valuable and enforceable, does it count as taxable income? I mean, that's the billion-dollar question right there, isn't it?
Yes. Yes, it does, unequivocally. An arbitration award becomes taxable income when it represents a gain from whatever source derived. This expansive principle, covering gains whether they originate from labor, capital, or, like in this case, the resolution of a dispute. It was firmly established by the Supreme Court way back in a landmark case from 1920. This broad interpretation ensures that nearly all forms of economic benefit are subject to taxation unless specifically exempted by law. And importantly, for corporations operating under the accrual method of accounting, which is standard practice for most businesses following generally accepted accounting principles, or GAAP, realization, meaning having the actual cash in hand, is not a prerequisite for taxability.
So the moment the award is final and binding, that's what triggers it, even if they haven't actually received the cash yet. That seems counterintuitive to a lot of people, I think. People who might think income only counts when it hits your bank account.
Exactly. Under the accrual method, income is recognized when it is earned or when the legal right to receive it is established. regardless of when the cash is actually received. So the moment the arbitration award is final and binding, the legally binding obligation it creates, and the quantifiable value it represents, well, that's sufficient to trigger taxability. The company has a legally enforceable right to that $1.2 billion. And that right, in and of itself, is deemed income for tax purposes under accrual accounting. This is a critical distinction and, yeah, often a point of confusion for those not steeped in accrual basis accounting.
Okay, that clarifies it. So we've got a $1.2 billion arbitration award. It's recognized as both a financial asset and as taxable income. Now, how do we actually report this on Form 1120? What's the specific place, the specific form or schedule involved in bringing such a substantial and frankly unconventional asset onto the corporate books for the IRS to see?
This is precisely where Schedule L becomes absolutely indispensable. Schedule L is essentially the company's balance sheet for tax purposes. It meticulously details all of its assets, liabilities, and equity at both the beginning and the end of the tax year. And it's on this schedule where you report your financial assets. So that $1.2 billion arbitration award, once it's recognized under the accrual method and its legal right to receipt, is established. It takes its place right here on Schedule L. Most likely categorized as a receivable or perhaps another significant asset, depending on the specifics. It won't just appear as a line item on the income statement. It directly impacts the company's stated financial health right there on the balance sheet.
So it's not just a footnote somewhere. It's right there, front and center, on the balance sheet, reflecting a massive shift in the company's financial structure.
Exactly. Schedule L provides a clear, comprehensive, and most importantly, transparent picture of the company's financial position to the IRS. Without Schedule L, the company's true asset base, especially with such a significant new component like this award, simply cannot be properly reflected. It's the foundational document for showing assets, liabilities, and equity. It gives the IRS that holistic view of the company's financial health, and it makes sure that huge new asset is accounted for from the start as part of the total financial landscape. This transparency is absolutely crucial for compliance and, well, for any subsequent audits that might come up.
So Schedule L is clearly critical here for this unique asset. It's where that $1.2 billion really finds its home on the balance sheet. Are there any common misconceptions about how such an asset, like an arbitration award, should be valued for tax purposes on Schedule L, particularly given its non-traditional nature, like, if the cash hasn't physically landed yet?
That's an excellent point, and yeah, a very common misconception. Perhaps the most prevalent is thinking that if the cash hasn't physically landed in the bank account, then maybe it doesn't need to be reflected yet on the balance sheet for tax purposes. People often conflate cash basis accounting with accrual basis. They think no cash, no asset.
Right, the out of sight, out of mind kind of approach.
Yeah.
Or the it's not real until it's in my hand mindset.
Exactly that. But as we discussed with the accrual method of accounting, the company's legal right to that $1.2 billion, once the award is final and binding and the amount is fixed, well, that means it must be recorded as an asset on Schedule L. Now, valuation for Schedule L generally follows GAAP principles, generally accepted accounting principles. So if the award is binding and enforceable, it's face value. The full $1.2 billion is typically what you'd use. There are only very specific, very well documented, and frankly, quite rare reasons for a lower valuation.
Like what, for instance? What would justify not valuing it at its full face value? That seems like the obvious thing to do.
Well, perhaps there's an extremely high demonstrable risk of non-collection, where the paying party is clearly in severe financial distress. Maybe they've declared bankruptcy, or they're actively challenging the enforceability of the award in a way that truly jeopardizes its collection. That could potentially justify a write-down, or there might be a formal arm's-length negotiated discount for immediate payment, where the company agrees to accept, say, $1 billion now instead of $1.2 billion later, and that's fully documented as such. But for a solid, legally binding arbitration award from a reputable process, you're almost certainly looking at recognizing its full value on Schedule L, precisely because the right to the income has been established. That's the trigger.
And what are the consequences of failing to do that? What if a company tried to, minimize its assets on Schedule L, play it down?
Well, failing to do so would fundamentally misrepresent the company's financial position to the IRS. And that's serious. That can lead to significant issues, including substantial penalties for understating assets, interest on any underpayments of tax, and it could even imply an attempt to understate income, potentially leading to more severe audit scrutiny. Transparency via Schedule L is absolutely key to maintaining compliance and avoiding these problems. The IRS expects, demands really, a clear and accurate reflection of your financial state.
That makes perfect sense. Total sense. So Schedule L is the primary place to list this asset, really painting the financial picture for the IRS. But thinking about a company of this size, I mean, with total assets now rocketing past $10 million because of this award, are there other related schedules that come into play? Things beyond what maybe a smaller firm might need. Schedules that also rely on the foundational information that Schedule L provides.
Absolutely. Schedule L doesn't exist in a vacuum, especially for larger companies. Once your total assets cross that $10 million threshold, Schedule M3 becomes mandatory. This is a much more complex and detailed schedule, replacing the simpler Schedule M1 that smaller corporations use.
Right, M3 instead of M1. What exactly does Schedule M3 do for the IRS that M1 doesn't, and how does it build on Schedule L?
Okay, so Schedule M3 is the net income or loss reconciliation for corporations with total assets of $10 million or more. Its core purpose is to provide a much more detailed reconciliation of the company's financial accounting income, what you might call its book income, typically prepared according to GAAP, to its taxable income, the number the tax is actually calculated on. It forces the company to explain granular differences between how certain items are treated for financial reporting versus how they're treated for tax purposes. For example, a company might depreciate an asset differently for its financial statements than it does for tax purposes. That's common. Or certain expenses might be deductible for book purposes, but not for tax. The arbitration award itself might be recorded as revenue in the books in one period, but its tax treatment might have nuances based on specifics. M3 clarifies that. Schedule M3 lays all these differences bare, building directly on the asset figures and overall financial picture established by Schedule L. And for partnerships with assets over $50 million, Parts 2 and 3 of Schedule M3 are also mandatory, further emphasizing its critical role for larger entities in ensuring the IRS has a crystal clear understanding of every dollar, every difference.
Okay, so M3 relies heavily on L, providing that deeper dive into the book-to-tax differences. Makes sense. What other essential schedules are linked into this financial ecosystem when we're dealing with a company of this scale and a financial event of this magnitude?
Well, you've also got other essential schedules that become highly relevant. There's Schedule J, which meticulously tracks tax payments and credits. And as we'll discuss later, that's going to be very relevant to our strategic planning here. Then there's Schedule K, which details changes in shareholders' equity. A huge income item like this arbitration award will directly impact the company's retained earnings and potentially shareholder equity, so Schedule K provides transparency on those movements. Potentially, Schedule O might come into play if there are complex related party groups involved, perhaps in the company's structure or the arbitration award's origins, requiring disclosure of transactions between related entities. And of course, you'll need to attach detailed computations for things like your net operating losses, which we mentioned earlier, and your estimated tax payments, all the backup documentation. But the crucial point is that these aren't just bureaucratic hurdles or isolated forms. They all build upon the comprehensive financial blueprint established by Schedule L, ensuring consistency and transparency across all aspects of the company's financial reporting to the IRS. They form an interconnected web, really, all pointing back to that foundational balance sheet.
So Schedule L is the cornerstone.
It really is. It provides the full, transparent financial story to the IRS, showing exactly how major assets like this arbitration award translate into the company's overall financial health and ultimately its tax obligations. It feeds critical detail into those other schedules like M3, J, K, ensuring that the company's stated financial position on its balance sheet, including unique assets like this arbitration award, aligns perfectly and transparently with its tax reporting across the board. It's the mechanism that ensures this massive new asset is fully accounted for and integrated into every aspect of their financial footprint, from assets to income to shareholder equity.
Okay, that's a brilliant explanation of how the arbitration award gets woven into the financial statements and flows through the various tax forms. Really clear. Now, let's shift gears slightly to another critical component of our company's financial situation we touched on. Our company also has over $1.2 million in net operating losses, or NOLs, carried over from previous years.
Right, a common situation for companies, especially newer ones, maybe those in cyclical industries, or those that have experienced significant investments in growth and perhaps haven't yet reached consistent profitability. NOLs are valuable assets in their own right, really. They represent past losses that can offset future income, a tax shield.
So how do these existing NOLs interact with this new, very large financial asset, this $1.2 billion arbitration award? And related to that, what's a strategic approach to estimated taxes now that such a significant award has suddenly come into play? This seems like a complex dance between a huge gain and existing losses. It feels like there should be some smart moves here.
It absolutely is a complex and strategic dance, a true exercise in tax optimization, if done right. Let's first quickly outline the mechanics of NOLs just to make sure we're all on the same page. They are reported on line 29A of the main Form 1120. Carrying them forward requires a detailed computation, which must be attached to the return as per IRS instructions. Pretty standard. IRS rules dictate how these losses can offset future income. It's also important for tax strategists to be aware of specific limitations. For instance, if there's been a significant ownership change within the company, the technical term is Section 382 limitation, meaning more than a 50% change by 5% shareholders over a 3-year period, as this can limit the usability of those NOLs, something to watch out for.
Right, so you got to watch out for those limitations because they can really impact how much of those valuable losses you can actually use to reduce your tax bill. Can kneecap the strategy?
Exactly. For most corporations today, NOLs can be carried forward indefinitely, meaning they don't expire, which is a significant benefit compared to older rules. However, the deduction in any single year is limited to 80% of taxable income before applying the NOLs. That's a key limitation now. So the calculation works like this. Taxable income on line 28 of Form 1120 is initially calculated as your total revenues, including that $1.2 billion arbitration award minus all your legitimate deductions, before you apply any NOLs. Then you subtract the allowable NOL deduction on line 29A up to that 80% limit to arrive at your final taxable income on line 30. This final figure is the one upon which your corporate tax liability is based.
Okay, standard calculation. But here's a fascinating twist that you hinted at, and it sounds really counterintuitive. The company in our scenario plans to pay estimated taxes before applying these NOLs. So, for example, based on just a portion of the award, let's say $600 million, they're calculating the corporate rate of 21%. Which amounts to $126 million in estimated tax payments. Wait, hold on. They're intentionally paying more in taxes, potentially much more than they might actually owe after applying their significant NOLs. That seems, well, completely against standard tax minimization strategy. I'm genuinely curious, why on earth would a company do that? What's the trade-off here? It feels like leaving money on the table.
This raises a truly important question, and it's where sophisticated tax planning really shines. You're right, it seems to defy logic on the surface. While there are strict rules about minimum estimated tax payments to avoid penalties, the underpayment penalties that no company wants to incur.
It's exactly the ones you definitely want to avoid.
Yeah.
Nasty surprises.
Precisely. But voluntary overestimation, choosing to pay more than the minimum required, that is not only permitted, it's actually recognized as a lawful prepayment of federal corporate income tax. There's no law, no statute, no regulation that prohibits a company from choosing to pay more estimated taxes than the minimum required. In fact, for a company in this situation, it can be a masterclass in leveraging the tax code, not just for mere compliance, but for, significant future financial leverage. It's about strategic capital allocation within the tax framework, thinking ahead.
So it's not just allowed, it's a recognized, legitimate strategy. That's actually quite ingenious. It transforms what seems like a simple tax obligation into a proactive financial pool. I wouldn't have immediately connected tax payments to building loan eligibility, but it makes so much sense when you think about it that way. But wouldn't putting that much capital into estimated taxes also tie up cash flow they could be using elsewhere? What's the real trade-off here? Are they sacrificing short-term flexibility?
That's a crucial point about the trade-off. Yes, it absolutely does tie up cash that could otherwise be immediately invested or used for operations, no question. However, for a company that has perhaps been struggling, maybe accumulating NOLs for years, its access to traditional financing might be quite limited. Banks might be wary. The return on investment for this tied-up cash isn't a direct financial yield like interest or dividends, but rather an intangible one, perhaps even more valuable in the long run: credibility and access to future capital. By deliberately paying these estimated taxes before fully applying those NOLs, the company effectively creates a substantial tax overpayment with the IRS. This overpayment then generates either a tax credit, which can be applied against future liabilities, or, more likely in the strategic play, a significant refund claim that can be applied to future quarters or even year-end tax liability. But the strategy serves a much more specific, powerful purpose beyond just a future refund. It builds a crucial tax history for the company.
A crucial tax history. Why is that so vital? Especially if they have a multi-billion-dollar asset on their books now. Doesn't that asset speak for itself?
Because many companies, especially those seeking significant financing, we're talking large loans, substantial lines of credit, or perhaps trying to attract certain types of sophisticated investors, or even trying to qualify for big government contracts. They often require proof of consistent tax payments over a period, typically 3 years, but sometimes up to 5. This demonstrates stability and operational reality. It shows they're a going concern, generating taxable income. Banks, lenders, even government agencies don't just look at a current balance sheet, which might show a huge one-off asset like this award. That's just a snapshot. They want to see a reliable income stream and a history of consistent, legitimate financial operations. And tax payments are hard evidence of that. They are verifiable, audited in a sense by the IRS accepting them, and demonstrate ongoing, legitimate business activity. An arbitration award is a fantastic asset, but it's a single event. Consistent tax payments tell a story of sustained operation over time.
Okay, that makes so much sense now. Wow. It's almost like they're building a credit score with the IRS, isn't it? Using the tax system itself to prove financial stability and unlock future capital. Can you give us maybe a hypothetical, more narrative example? How a lack of tax history might hinder a company's growth, even one with a big asset like this arbitration award?
Absolutely. Imagine a scenario where our company, despite having this massive $1.2 billion asset clearly shown on Schedule L and now recognized as income, wants to secure, say, a $100 million loan, maybe to expand operations quickly, acquire another business, or bid on a large, lucrative government contract. When they approach a bank, the bank's due diligence team will definitely ask for several years of tax returns, standard procedure. Now, if the company had merely minimized taxes by fully utilizing its NOLs in prior years, those returns would show zero or very low taxable income, and thus zero or very low tax payments for years.
Right. The award as a one-off event doesn't inherently show ongoing sustainable business. It's a snapshot, not a trend line. The bank needs to see that regular heartbeat of financial activity, proof of life.
Exactly. So in the bank's eyes, despite the current multi-billion-dollar asset, the company might appear new or perhaps dormant in terms of continuous revenue generation and tax compliance, which are key indicators of financial health and stability for lenders. They might struggle to get favorable interest rates. They might face much stricter loan covenants that restrict their operations. Or they could even be denied the financing or the contract altogether, a worst-case scenario. A hypothetical deal, maybe vital for their growth and expansion, could fall through simply because they lack that established multi-year tax footprint. The footprint that proves consistent financial activity and compliance over time. This strategic overpayment, legitimately backed by funds from the arbitration award funds whose source is clearly identifiable and linked to the asset on Schedule L, it fills that crucial gap. It gives them immediate, verifiable financial credibility where they previously had none in the eyes of these crucial external stakeholders like banks and government agencies. It transitions them from a company with a potentially sporadic or zero tax history to one demonstrating consistent financial robustness almost overnight.
Wow. What a powerful way to leverage a unique financial position. It's really not just about compliance anymore. It's deep into strategic financial planning for long-term growth and credibility. It surely turns a tax obligation into a tool for future financial leverage, giving them a significant leg up in the competitive financial world. It's a true financial masterstroke when you think about it that way.
Indeed, it demonstrates a highly sophisticated understanding of the tax code beyond just simple compliance, viewing it as a strategic lever for business development and expansion. And furthermore, these estimated payments can serve another important purpose. They can potentially be used to cover not only the current year's taxes, but also any outstanding back taxes from the past 3 years, if applicable, if they had any lingering issues. This helps them build an even more comprehensive, positive financial statement of assets, satisfies any prior tax liabilities, and solidifies their financial standing across the board, making them an even more attractive prospect to lenders and partners.
So it's like cleaning up the past while simultaneously building the future. A simultaneous boost to both historical and current financial health. Very smart.
Exactly. And, this isn't just a strategy for multi-billion-dollar corporations. The underlying principle, strategically building a verifiable financial history through consistent, documented payments, that can apply to a startup trying to secure its first significant loan, or even a small business seeking better credit terms from its suppliers. It's about thinking beyond just the current tax bill and using every available lever within the tax code to enhance your company's overall financial strength and reputation, regardless of scale. It's about perception and proof.
Okay, so our company has built this incredible financial credibility. They've established a robust tax history with the banks and potential investors. Leveraging that massive arbitration award and its strategic estimated tax payments. This is a huge step forward for their long-term stability and growth. It puts them on a much better footing. So what does this all mean for paying their contractors, who, as we mentioned earlier, are a significant part of their operational model? can they now issue bills of exchange to their contractors as a preferred payment method? And if so, how would that work step by step? This is where the rubber meets the road, right? Taking that high-level financial strategy down to the day-to-day operations?
Yes, absolutely. The company can potentially issue bills of exchange to pay its contractors now. And this is indeed a sophisticated next step, one that directly leverages their newfound credibility and strong financial standing that they've worked to build. It's a mechanism that allows for more flexible and strategic management of accounts payable. Most listeners are probably familiar with the bill of exchange, or maybe called a draft, as a formal written order for payment. Here's how our company, acting as the drawee, can strategically use it with their contractors, who would be the draws.
Okay, right. So just to clarify the roles again for our specific scenario, the company would be the drawer, meaning the one instructed to pay, and the contractor would be the drawer, the one issuing the order.
That's correct. Our company is the drawee, the one accepting the obligation to pay later. The contractor is the drawer who issues the bill initially. Now, let's walk through the step-by-step process of how bills exchange would work in this context, illustrating how this advanced financial instrument comes to life in their operations. Step 1, issuance. The contractor, acting as the drawer or supplier, creates the bill of exchange. This document is typically sent to our company, the drawee or customer, usually along with their invoice for the services they've rendered. The bill will clearly specify the exact amount due, the agreed-upon payment due date, and details like the parties involved. It's essentially a formal proposal for a deferred payment arrangement. Step 2. Acceptance. Now, this is a profoundly crucial step, cannot overstate this. Our company, as the drawee, formally accepts the bill by signing it, usually right on the document itself. This signature signifies their unequivocal agreement to the deferred payment terms and, importantly, acknowledges their debt to the contractor. By accepting, our company becomes the primary debtor, legally obligated to pay the amount specified on the bill by the maturity date. This acceptance transforms the bill from a mere request into a fully valid and legally enforceable financial instrument. And it's at this point that the company's strong financial credibility, built through those strategic estimated tax payments and its solid balance sheet, plays a vital role. The contractor knows this accepted bill is backed by a financially robust and compliant entity. It has real weight. Step 3, endorsement by the contractor. Okay, so once the company has accepted the bill, the contractor, who is the original drawer and payee, endorses the bill. This usually means they sign it and often include their bank account number on the back of the document. They then hand this endorsed bill over to their own bank. This step is particularly crucial if the contractor wants to discount the bill, which means they want to receive an early payment from their bank rather than waiting until the bill's maturity date. Get the cash sooner. The contractor's bank is much more likely to offer favorable discounting terms because the bill is accepted by a company with a strong, verifiable financial history. Less risk for the bank. Step 4, payment on the due date. Finally, on the specified maturity date, the contractor's bank, or whoever happens to be the current holder of the bill, collects the amount due directly from our company's bank account. This is typically a direct debit process, ensuring the payment is made as agreed upon. A smooth, automated transaction that finalizes the cycle.
That's a very clear and detailed process. Yeah, makes sense how it flows. Now, what are the mutual benefits here? What's in it for our company to use these, and what's in it for the contractors? Because it really has to be a win-win for it to be a sustainable method of payment, doesn't it?
Absolutely. The mutual benefits are key to their adoption and continued use. It needs to work for both sides. So for the company, as the draw customer, our company benefits immensely from deferred payment terms. That's the big one for them. This means they can receive valuable services from their contractors without the immediate outflow of cash. This is a powerful cash flow management tool. It allows the company to retain its working capital and set aside the funds until the agreed-upon due date, rather than having to pay immediately upon invoice receipt. This flexibility, especially maybe with a large arbitration award that might be coming in tranches or is being strategically used for those estimated taxes, well, it's incredibly valuable. It allows them to align their outflow of cash with their inflow, optimizing liquidity. Huge benefit. And for the contractors, as the supplier pay. For the contractors, a bill of exchange provides a very strong guarantee of payment at a later date. Once the bill has been formally signed and accepted by our company, that is, this acceptance turns it into a legally binding obligation, far more secure than just a simple invoice sitting in accounts payable. Furthermore, and this is a significant benefit for them, it allows the contractor to discount the bill with their own bank. This means they can essentially sell the bill to their bank for immediate funds, minus a small commission or discount fee. This provides them with much quicker access to capital if they need it, without having to wait for the bill's maturity date. Helps their cash flow tremendously. It also offers a very secure method of payment with clear legal recourse if payments aren't made as agreed, which adds a crucial layer of trust and security to the transaction, potentially enabling contractors to take on more projects with better cash flow certainty. And for overall business transactions, generally, the use of bills of exchange facilitates credit in business transactions, allowing for smoother and more flexible dealings, which can foster stronger business relationships over time. They can significantly enhance trust and reliability in trade relationships because there's a clear, legally binding instrument backing the payment, reducing uncertainty for both parties. Ultimately, it establishes a clear and enforceable legal relationship between the creditor, contractor, and the debtor company, which is beneficial for both parties in ensuring clarity and accountability, laying a foundation for long-term partnerships.
That's a really comprehensive overview of the benefits. It sounds very appealing for both sides under the right circumstances. Now, moving to the practicalities and the fine print. What are the key elements a bill of exchange absolutely must have to be valid and enforceable? And what important legal and practical points should our company consider before implementing this method of payment with their contractors? Got to get the details right.
Excellent questions, because this is where the precision really matters. A bill of exchange is a formal legal document, so it must adhere to specific, strict requirements to be considered valid and enforceable in a court of law. No shortcuts here. Here are the key elements of a bill of exchange. First, it must be in writing. Obvious, maybe, but essential. This isn't a verbal agreement, it's a physical or verifiable digital document that can be held and presented. Second, the term bill of exchange, or sometimes draft, must be explicitly included in the document itself, usually prominently displayed. This signals its specific legal nature. Third, it must contain an unconditional order to pay a specific, certain sum of money. Unconditional is key. There can be no conditions or contingencies attached to the payment. No, if X happens, then pay. It's a direct command. Fourth, it must clearly name the drawer, the contractor, the draw, our company, and the payee, who will ultimately receive the payment, often the drawer again or their bank. Ambiguity here can invalidate the instrument. Fifth, it must include the date and place of issuance, providing a clear point of origin and context. Sixth, it must specify the maturity date, that is exactly when payment is due, and the place of payment, usually the drawer's bank, making the terms entirely predictable and actionable. And finally, it must bear the signature of the drawer, which, in our scenario, is the contractor. Without the contractor's signature, it's not a valid bill, as it lacks the originating party's formal assent and order. Now, for legal and practical considerations for our company before they dive into this method. Legal requirements. It is absolutely crucial to ensure full compliance with all relevant bills of exchange acts and regulations in the specific jurisdiction where the transaction occurs. Laws can vary, sometimes significantly, and the document must meet all local legal requirements to be considered valid and enforceable. Any omission or error, even seemingly minor, could invalidate it and lead to complex legal disputes. Accuracy. All details, dates, amounts, names, addresses must be perfectly accurate and clearly stated. Precision is paramount to prevent costly errors or disagreements down the line. Double-check everything. Acceptance. As mentioned, the bill absolutely requires formal acceptance by the drawee, our company, to be legally valid and binding. Without the company's acceptance signature, it's just an order, not a binding obligation. This is the moment the company fully commits to the payment. Record keeping. Maintaining meticulous, detailed records of all bills of exchange issued and accepted is critical for effective financial management, for audit trails, and for tracking future payment obligations accurately. This protects the company from both a financial and compliance perspective, enabling clear reconciliation. Legal advice. And finally, and I cannot stress this enough, it is crucial for our company to seek specialized legal advice before implementing the widespread use of bills of exchange as a payment method. This ensures full compliance with all applicable laws, helps them understand all legal implications, and ensures that the agreements are drafted properly to protect the company's interests and mitigate risks. This isn't a DIY payment solution. Get professional guidance.
That's an exhaustive list of requirements and considerations. It sounds like a powerful tool, but one that absolutely demands precision and legal diligence. No room for error. Are there any potential downsides or drawbacks that our company should be aware of when considering this payment method for their contractors? Every strategic decision usually has a flip side, doesn't it?
Yes, that's true. There are a few potential drawbacks that need to be considered, ensuring a balanced view before adopting this. Firstly, Bills of exchange are primarily suited for short-term services or transactions. While technically they can be for any duration, their common use cases and banking practices align better with shorter payment cycles, typically 30, 60, or 90 days. For very long-term projects, other financing arrangements might be more suitable. Secondly, our company, as the drawer, bears the ultimate and unavoidable responsibility for ensuring payment is made by the due date. There's no escaping that obligation once they've formally accepted the bill. This means robust cash flow forecasting and management are absolutely essential to avoid default. Thirdly, while the discount fee is typically borne by the contractor if they choose to discount the bill with their bank, our company might indirectly bear additional costs. This isn't a direct financial cost to our company, but if contractors consistently incur these fees, it could subtly affect future rate negotiations or their willingness to accept bills of exchange as payment, something to be aware of. Fourth, compliance and differing legal interpretations across various jurisdictions can be complex, especially if our company begins dealing with international contractors. The laws governing bills of exchange can vary significantly from one country to another, requiring careful legal navigation and potentially different documentation. And finally, while legal recourse is available if the company were to default, there's always a residual risk of non-payment or delayed payment from the company's side if unforeseen financial circumstances arise. Although the legal framework is strong, enforcement can still involve time and expense for the contractor. These are all factors that the company should weigh carefully, understanding that while powerful, bills of exchange are not entirely without their complexities and risks.
So what does this all mean for you listening in? Today, we've taken a really deep dive into how a single powerful financial instrument, this multi-billion-dollar arbitration award, can fundamentally reshape a company's entire tax strategy. We've seen its meticulous reporting on essential forms like Schedule L, which truly captures the essence of these unconventional assets directly on the balance sheet, reflecting the company's true financial health.
That's right. Schedule L is the crucial step that underpins everything, isn't it? Giving the IRS a transparent and holistic view of the company's financial state, including these major, often unexpected assets, it's foundational.
Exactly. And we move from that crucial step to the company's proactive, strategic approach to estimated payments, which isn't just about compliance, but about building vital financial credibility in the eyes of lenders and potential partners. A really smart play. And finally, how that credibility, once established, can open doors to sophisticated payment mechanisms like issuing bills of exchange to contractors, turning a simple payment obligation into a flexible cash flow management tool. It's a powerful example of how understanding the nuanced definitions of assets, the mechanics of critical forms like Schedule L, and the inherent flexibilities within complex tax codes can lead to significant strategic advantages, truly transforming liabilities into leverage.
And if we connect this to the bigger picture, it really highlights that financial instruments aren't always what you might conventionally expect, like stocks or bonds. An arbitration award, something stemming from ancient common law principles, believe it or not, can be a core dynamic financial asset in a company's portfolio. It directly supports a company's balance sheet via Schedule L, provides that transparent financial story to the IRS. And as we saw, can even influence its ability to secure future funding by proactively building that robust tax history. Ultimately, this enables more flexible and strategic operational practices like using bills of exchange. It's really about recognizing value in sometimes unexpected places and understanding how to integrate that value into a comprehensive, forward-looking financial strategy.
So maybe consider how broadening your perspective on what truly constitutes value and how it interacts with financial reporting and tax strategy could unlock unforeseen opportunities in your own endeavors. How might understanding the inherent nature of agreements, obligations, liabilities, perhaps beyond just the standard statutory definitions usually work with, how might that reveal hidden potential in your own financial or business ventures? It might just lead to your own surprising strategic advantages and new ways of thinking about your company's financial footprint and potential, something to mull over.